Welcome, good people. We are going to discuss the ATD Level 2 financial accounting paper, which was done in August 2021. So it's an August 2021 financial accounting paper for ATD Level 2. And this is question 3 of the paper. So Dan and Lucy are partners, sharing profits and losses in the ratio of 3:2 respectively. The partnership agreement provides for Lucy to receive a salary of 8 million per annum. Interest on capital is allowed at the rate of 5% per annum. Their statement of financial position as at 31st July 2020 was as follows. So we have premises, equipment, inventory, accounts receivable, cash, capital accounts, current accounts for both Dan and Lucy, then current liabilities, accounts payable. So additional information on 1st November 2020, Pendo was admitted to the partnership. The terms of her admission were as follows. Interest on capital was raised from 5% per annum to 6% per annum for all the partners. Pendo introduced 24 million in cash as capital into the partnership. Pendo received a salary of 12 million per annum. Lucy's salary was raised to 12 million per annum. The profit sharing ratio for Dan, Lucy, and Pendo was then adjusted to 4:2:1 respectively. Profits for the year ended at 1st July 2021 was 111,570,000. So as at 31st July 2021, the working capital of the partnership was inventory, that, accounts receivable, cash, and accounts payable and accruals. Partners' drawings for the end at 1st July 2021, Dan, Lucy, Pendo, and then non-current assets depreciated at the rate of premises 5% on cost and equipment 10% on cost. We are required to come up with a statement of profit or loss and appropriation account for the end at 1st July 2021 and the partners' current accounts. Statement of financial position as at 1st July 2021 is also expected from us at 6 marks. So then we will go straight to the first item, statement of profit and loss, and then move to partners' current accounts before we embark on the statement of financial position. Statement of profit or loss and appropriation account. The good thing about this question is that I've seen we've already been given the profit and the profit for the year, item number 2. The profit for the year was 111,570,000. So that means that we may not go through the trading account and the profit and loss account per se, but straight to the appropriation account. So we'll go straight to the appropriation account because we have the first part of the question has already been done for us. So let's start. Let's start and keep going. So this is Dan, Lucy, and something else that I think is very important on this question for us to know is that remember we started the business as 2 partners, that is Dan and Lucy, and at some point there was this third partner who joined us, Pendo. So we need to know we need to apportion the number of months that the business operated with 2 partners and the number of time the business operated with 3 partners. So if we are preparing the books as at 31st July, for the end at 31st July 2021, and Pendo joined on 1st November 2020, and the books are for the year ended at 1st July 2021. So this means our opening stock. Let me just see our opening stock. Opening inventory stock, opening stock. Let's see. This is 1st November. When did this business start? The statement of financial position as at 31st July was as follows. Okay, so 31st July 2021. So if you're talking about 31st July 2021, it means the preceding year, this is 31st July 2021. So the preceding year was 31st July 2020. So it means a financial year starts from 1st August 2020, started in 1st August 2020 up to 31st July 2021. So from 1st August 2020, so August it operated with 2 partners. September it operated with 2 partners, and then October it operated with 2 partners. So these are 3 months. So that 1st November they admitted who? Pendo. So it means the first 3 months we had how many partners? 2 partners, and then the remaining 9 months we talk about the 3 partners. So the first 3 months 2 partners, the remaining 9 months the business was run by the 3 partners. So that is very important for us to note, that 2 partners only apply in the first 3 months of the business financial year, and then the remaining 9 months were done by the 3 partners. Okay, so let's go back to the question again. Okay, I think we are good to go. So we'll just come here and say done. So let's say the solution for this question, solution. So we'll say done Lucy and Pendo partnership, done Lucy and Pendo partnership, and we'll go straight to the appropriation account. Let's call it income statement appropriation account. In fact, we can just call it income statement. There's no harm. Income statement, because income statement goes all the way to the appropriation account. Then for the year ended, 31st July 2021. And then of course we underline this. This is our heading, so we need to underline. And in normal circumstances, we'll have started with the trading account, then go to the profit and loss account, and then head to the appropriation account. But in this case, we've already been given the profit. So we'll start right away from the profit. And the profit for the year ended at 1st July was 111,570. Since we have already restricted the zeros, we'll just have 111,570 like that, and then we proceed. There's maybe just confirm, check if we have anything for any expenses that might have required the use of the profit and loss account, and maybe anything that is on the trading account. I think we don't have any, so we go straight to the appropriation account as captured by the question. So net profit 111,570. This is item number 2. The profit for the year that 1st July was 111,570. So because this is appropriation, we check appropriation. Normally what we need to include are interest on drawings, if we have any interest on drawings, if we have salaries to the partners, if we have interest on capital, it will also feature there. If we have, and then of course profit share will definitely feature here. Profit share, these are some of the things that will come under the appropriation account. And because all these things will affect the partner's current account, I think let's just move together. So we'll work, this is our income statement appropriation. So I think let's just leave enough space to, and then start also the partner's current account. So let's have the partner's current account here so that we can just fill them together. Partner's current account, and that's how normally for partner's current account. Since there are 3, we have the 3 columns. Let me just get this line right. So we'll have the 3 columns. Sorry. like that, and then again like that. Good. So then we'll have let's have this horizontal line flowing like that, and then this one also flowing like that. Good. So then we have the credit side and we have the debit side of the partner's current account, and of course we'll now have the DLC. This is Dan, Lucy and Pendo. Dan, Lucy and Pendo. And then of course here we have the details, and here also we have the details. So we'll be working together the two books. So let's look at, because we are interested in the current accounts, we'll just pick the balances as they are. Current accounts, Dan 6,400, Lucy 600. So we come here and say balance brought down. So Dan, how much? Dan is 6,400, Lucy 600 negative. So Dan 6,400, the credit side, Lucy 600, and that's how we go about it, because this is a partner's money that belongs to the partners. It's a credit, it's a liability to the business, it's capital. So capital is a credit account and it's also a liability to the business. So it's found on the credit side of the business. So we have captured that. We have already captured that information. Where is it? Here, current account 64 and 600. We've captured that. So then let's look at something else that will affect the appropriation account. Okay, on 1st November 2020, Pendo was admitted to the partnership. The terms of admission were as follows. So interest on capital was raised from 5% per annum to 6% per annum for all the partners. Interest on capital was raised from 5% per annum to 6% per annum for all partners. So 5% per annum. It means the two partners were enjoying interest on capital at 5% per annum for the first 3 months. So what you are going to do is simply work out interest on capital, and interest on capital we've been told is 5%. So this is 5%. 5% of what? Capital. For Dan, it's 32,000. For Lucy, 20,000. So 5%, I think let's work it from here. 5% of 32,000. This one will only apply for the first 3 months. And then for Lucy will also be 5% of 20,000 times 3 over 12. So this gives us 0.05. Just use your calculator. 0.05 times 32,000 times divide by 4. This gives us 400. So 400. And then for Lucy, we'll have 0.05 times 20,000 divided by 4. That gives us 250. So Lucy is 250 and Dan is 400. So that's how we'll come down here and say interest, first quarter interest, first quarter interest on capital. Interest on capital. So Dan is 400 and Lucy is 250. Of course, we didn't have partner Pendo. So then we go to the remaining 3 quarters interest on capital again. Interest on capital for the remaining 3 quarters of the year. So we'll have now this time it was increased from 5% to 6%. So it means for Dan we'll now have 6. Okay, so this is what will transpire. It will now be like that. And of course, let's also do away with this. So it means we'll have 6%. Now this is the remaining 3 quarters of the year, 6%, and also 6% of the capital that was introduced by Pendo which is 24 million in cash as capital into the partnership. So Pendo introduced 24 million in cash as capital. So of 24 million times 9/12, the remaining 9 months, like that. So the answers we get will be interest on capital for those partners. So 0.06 times 32,000 times 9 divided by 12. That gives us 1440. Then 0.06 times 20,000 times 9 divided by 12. That gives us 900. And then 0.06 times 24,000 times 9 divided by 12. That gives us 1080. 1080, like that. So 1440, 900 and 1080. 1440, 900 and 1080. So 1440, 900 and 1080 respectively. So this will be their interest on capital. The first quarter, there are 2 partners, like that. And then the remaining 3 quarters will be distributed like that at 6% per annum. Interest on capital is a credit account because it increases on the partners' wealth in the business, rather the liabilities of the business. So it's found on the credit side. Okay, we can as well put that here, but let's just proceed with the partner's current account. Then we'll lift everything to the appropriation account. It can also work that way. So let's move on to the second item. Pendo introduced 24 million in cash as capital into the partnership. That will go straight to capital account. It doesn't have any effect on the partner's current account. Then Pendo received a salary of 12 million per annum. Pendo received a salary of 12 million per annum. Then Lucy's salary was raised to 12 million per annum. So there's something here. I think before the salary of Lucy's salary was raised to 12 million per annum, she was earning some salary here. The partnership agreement provides Lucy to receive a salary of 8 million per annum. So Lucy was to receive 8 million per annum. 8 million per annum. So if it's 8 million per annum, how much was she receiving per month? That will be 8 million divided by 12. That gives us 6666. But we all know that now that the agreement, the previous agreement only lasted for 3 months in that particular year. So times 3. So it means Lucy earned 2,000 for the first quarter of the year. Actually, she was supposed to earn 2,000 every quarter. You can see this is 8 million per annum, and the year has 4 quarters. So every quarter she was supposed to earn 2 million. So we'll simply come here and say salary, because salary also affects the partner's current account. So salary under Lucy, because only Lucy who was earning salary, first quarter, Lucy will earn that. And then salary for the remaining part of the year, now Lucy will earn, because Lucy's salary increased to 12 million, and Pendo's salary also increased to, was agreed at 12 million. So if they are earning 12 million per annum, that simply translates to 1 million per month, and they worked under this agreement for 9 months. So it means the 9 months that this agreement was in force, they earned each of the 2 partners earned 9 million. Each of them earned 9 million because they agreed at 12 million per annum, but that agreement only lasted for 9 months. So we'll apportion, and that will translate to 9 million. So we'll simply come here and say salary D was not anywhere in the salary agreement. So for L, 9 million. For P, also Pendo, 9 million. The assumption here is that we've restricted the zeros, and actually you need to show, so sorry for that, we need to show that we are talking about shillings and then restrict the zeros. It's very important that you restrict these zeros to avoid any confusion or any doubt like that. So restrict the zeros like that. So then we have captured the salaries well. Let's move to the next item. The next item is the profit sharing ratio for Dan, Lucy, and Pendo was adjusted 4 to 2 to 1. But let's confirm to make sure that we've captured everything before we go to there, because this is normally the last thing. So we come here, the profits for the year, that one has already been captured. Working capital for the partnership, all these are have nothing to do with the partner's current account. Then partners' drawings for the year ended 31st July was followed. These are drawings. Drawings have the effect of reducing the partner's net worth in the business. So we debit the partner's current accounts. We debit the partner's current account. So we'll simply come here and say done 51,410. Done. So these are drawings. And this was balance brought down. Sorry for that. So drawings 51,410. Hope I've captured the figure right. We just confirm. So drawings 51,410 is good. Then Lucy 39,050 and then 16,500. 39,050 and then 16,500. So those are our figures. Good. I think we are good to go. Then where are we? We are here. Then the non-current assets are to be depreciated. That depreciation, that will affect the balance sheet. Current accounts, of course, this is where we started from. I'm just checking. We don't have any other thing. Now, if we don't have any other thing, then what is remaining for us to do is to simply share out these profits. We share out the profits. So how do we share the profits? This is the point where we realize that we needed to have done this. You know, appropriation comes first before the partner's current accounts. You cannot share profits from this partner's current account. But at least the partner's current account has enabled us to know the interest, the salaries, and so it's just a matter of transferring them up there and then we get the figures. So let's come here. Interest on capital. So I'll simply come here and say interest on capital. This one, it is the business paying the partners. Interest on capital. So at the first instance, we have who? We have Dan and Lucy. Dan and Lucy. And how much were they sharing? Interest on capital 400 and 250. So we'll talk of 400 and 250 like that. Alternatively, what we can do is to just to make our work neater, we can have 400 and 250 here, 400 and 250, so that the total now comes here. This will show that this is interest on capital the first quarter, and then interest on capital again the second quarter. Now we have Dan, Lucy, and Pendo, and the figures we have are 1440, 900, and 1080. So 1440, 900 and 1080. This is the remaining 3 quarters of the year. So we simply add 1440 plus 900 plus 1080. That gives us 3420. So 3420 here. And then when we add the to 3420, 3420 plus 650, we get 4070. Bring it here as our total interest on capital. Then we move to salaries, of course. And for salaries, we have Lucy. Lucy, who got how much? Lucy got 2,000 at the first instance. See, she was the only one. We just say 2,000. And then again, we'll have, this is first quarter. And then the remaining 3 quarters of the year. We talk of Lucy again, 9,000. Now this one will have to come here. Lucy 9,000. And then Pendo 9,000. Totaling to 18,000. And this gives us 20,000. Like that. 20,000. So that is 2,000 plus 18,000. We get 20,000 as our salary. And we less it from there. Now, check again. Check if we have anything remaining. Check if we have anything remaining. This is we've captured that. We've captured drawings. Normally doesn't feature, but interest on drawings we could have added to the net profit. Since we don't have interest on drawings, we'll simply come here and say 111 570 minus 4070 minus 20,000. That gives us 87,500. So 87,500, you make sure you leave enough space here because we want to distribute this 87,500. This is the remaining amount, 87,500. Once you distribute this, we will have shared out the entire 111,570. So it's this. We've already paid the partners this. We've also paid them this 20 million. So the balance it is 87,500, which is supposed to be shared as profit. So we'll come here and say profit share. And for profit share, you need to remember we have the first quarter and then we have the third quarter. So the first quarter we have Dan and Lucy. And then the second, the 3 quarters that is remaining, we have Dan, Lucy, and Pendo. The ratio 4 to 2 to 1. And here the ratio is 3 to 2. So that is very important. And because the question is silent on the proportion of how they shared the profits and losses, you can see Dan and Lucy are sharing the ratio 3 to 2. And then they have not said which proportion of profit is basically made in the first quarter and which one is made in the last 3 quarters. So we'll just assume and divide this by, either divide by 4 so that we get the profit per quarter. Alternatively, just take 87,500 divided by 12 months. Divided by 12 months, because this is for the whole year. So we divide by 12 to get the profit per month. Once we get the profit per month, we are interested in the first 3 months and then the last 9 months. So the first 3 months times 3, this will give us 21,874.99999. So we can call it 21,875. So the first 3 months will give us 21,875. And that means that the remaining 3 months, in fact, we can just work it out, will be 87,500 times 9 months divided by 12. This gives us 65,625. 65,625. Yeah, like that. So if you add 21,875 and 62,625, you'll get 87. Is it? I've written my own stuff here. This is not 62,625. It is 65,625. Good. So if you add the two, you should be able to get 87,500. So the first 3 quarters, this is the profit that will be distributed among the partners, and this is how they are going to be to enjoy. The remaining 9 months, this is the profit that will be distributed, and this is how they are going to enjoy in this ratio. So Dan, how much will Dan get? Dan will get 3 over 5. That is 3 over 5, this ratio, 3 over 5 times 21,875. This gives you 13,125. 13,125. And then Lucy will get 2 divided by 5 times 21,875. That gives you 8750. 8750, like that. So if you add the two, 13,125 plus that, to get 21,875. So this is how they're going to share the profit the first quarter. Then the second, whatever that period, the second period of time, that is the remaining 3 quarters of the year, they will share. This is the profit they are going to share, 65,625, and they're going to share in the ratio 4, 2 to 1. Add the 3, you get 4 plus 2 plus 1 is 7. So Dan will get 4 over 7 of 4 over 7 of 65,625. That is 37,500. So this is 37,500. And then Lucy will get 2 over 7 times 65,625. That is 18,750. 18,750. And of course, Pendo will get 1 over 7 of that, and that is 93.75. If you add this, you are going to get that. So this is how they are going to share the profits. And this completes our appropriation account. So you can see we've deducted this interest on capital because it has gone to the partners. Salaries we have paid the partners, and profits we have distributed as follows to the partners. So when we come here, we simply say profits, profit distribution, because it increases on their wealth. We say profit share, and this is first quarter. So for Dan 13,125, then for Lucy 87.50, and of course Pendo was not there. Then the remaining 3 quarters of the year, Dan 37,500, then Lucy 18,750, and lastly Pendo 93.75, like that. That's how we go about it. That's how we go about it. Then we close it down. If we don't have any other thing, close it down. That's how you close it down. That's how you go about it. So we're on the right track. So let's add the whole thing. This will now be 1080 plus 9,000 plus 93.75. This gives us 19,455. So 19,455. Then 250 plus 900. We're supposed to add the side with the highest figure. Just imagining that this will give me the highest figures, because in most cases it is the credit side that will give you the highest figure, but it's not a guarantee. So this is 39,650. Then I check on the debit side, and I can see this side is also 39,650. So 39,650. You can see this is already balancing. And this one is obviously higher than this side. So this will be our balancing figure, 19,455. And then lastly, this is 51,410. Looks like it's very high. But let's see the other side. That 7 plus 13, yeah, this side is definitely bigger, the credit side. So let's get the total on the credit side. 64 plus 4 plus 1440 plus 13,125 plus 37,500. That gives us 58,865. 58,865. 58,865. Like that. So then 58,865 minus 51,410. 51,410 gives you 74,55. So 74,55 is our balance carried down. And then of course here will be 0, because you know that 9,650 and that 9,650 is balancing. Then this that other side, it will be 19,455, that is for Pendo, minus 16,500. This gives you 29,55. 29,55, like that. 29,55. So we are done up to there. 29,55. We are done up to there. So the partner's current account, done. The appropriation account, done. You can see how we've used these figures. These figures have to come from the appropriation account. Now the next thing is to prepare the statement of financial position, and we are going to have this is partner, I think it was P, L, and sorry, Dan. This is Dan, Lucy, and Pendo partnership. Dan, Lucy, and Pendo partnership. Then we say statement of financial position. Statement of financial position. as at 31st July 2021, like that. So we underline that, like that. So then we have shillings, and shillings, and you can now restrict the zeros, like that. So we start with the non-current assets, and as usual, here normally we have the book value and then the accumulated depreciation and then the net book value. Let's get the book value of these assets. Premises 48,000. Premises 48,000. Equipment 16,000. So premises 48,000. Premises 48,000. Where do we have it? Yeah, this is the book value. So 48,000, and then equipment, I think it was equipment, at 16,000. And of course, the next thing now is to get the accumulated depreciation. Here we normally have the accumulated depreciation, and then the net book value. So accumulated depreciation, let's go for the for the accumulated depreciation. Accumulated depreciation will have, now premises is 5% on cost, equipment 10% on cost. Yeah, that is straightforward. Premises 5% on cost, equipment 10% on cost. So let's just come to the cost. Premises 5% on cost. So it's 5% of 48,000. That gives you 2,400. So the depreciation for this year is 2,400 plus what had accumulated before, 6,400. This will give us 8,800. 8,800 as our accumulated depreciation. Then let's move to the second one, equipment, which is depreciating at 10% on cost. Remember, if they say on cost, you work with the original figure, the historical cost. But if they say reducing balance, you work with the net book value, which are these figures. The cost less the accumulated depreciation, which are these figures. So in this question, we've been told on cost, so it will be 10% of the original cost of the said assets. So 10% of 16,000 is 1,600. Yeah. So we take 1,600 for this year plus what has accumulated, which is 9,600 over time. So this will give us how much? 11,200. I think you can see that 11,200. Add the two, it's 11,200. So we bring those figures. Those are the figures we are interested in: 8, 8, and 11, 2. So 8,800 and 11,200. So come here, we say 8,800 and 11,200. Those are the figures we are interested in. So we less from this, and 48,000 minus 8,800. What we get is that 9,200. And then for this one is 16,000 minus 11,200. The answer is obvious, 48. So 48. I doubt if we have any other asset, but we'll check. So this will give us 44,000. That will give us 44,000. I doubt if we have any other asset, but let's check. Any other non-current asset, that is. Yeah, so we don't have, unless if we have it in the additional information, we don't have. So we move on to the current assets. Current assets, inventory 11,200. So this is current assets, inventory 11,200. The statement of financial position was at 1st July 2020. So inventory 11,200, accounts receivable 44, and cash 800. Inventory 11,200, accounts receivable 4,400, and cash 800. Let me just carry those figures as they are. So inventories, current assets, inventories, accounts receivable, bank. Inventories was 11,200. Let me get the figures again. Sorry. These figures, and just you need to check. There's something here. This was the statement of financial position as at 1st July 2020. So we need not to get the inventory here, because this is for the year 2020. As for non-current assets, okay, because this cost remains the cost, and this is what had accumulated. We've just added what the depreciation for this year. But for current assets, let's get these figures from here. So inventory, yeah. As at 31st July 2021, the working capital of partnership, inventory, accounts receivable, and cash. So we have 25,110, 7,000, and 17,260. 25,110, 7,000, and 17,260. So let's get those figures. Sorry for this. 25,110. So inventory is 25,110. Then 7,000 accounts receivable. Then 17,260, like that, and then check if we have any other additional information. Do you have any other additional information? Accounts payable and accruals? No. This one, no. So we are done. But let's go with the accounts payable once and for all. Accounts payable and accruals 6960. So let's accounts. Current liabilities, accounts payable, and accruals 6960. In fact, this time round we can just work these figures here, then take the working capital the other side. There's no harm. So 25,110 plus 7,000 plus 17,260. This gives us 49,370. 49,370. If you are going to put them the other side, then this 6960 will have to come here, and there's no need to put it here because it's the only one. Otherwise, you can also take current assets minus current liabilities, get working capital, then add working capital to the non-current assets. So now that we have chosen this route, what is the answer here? The answer there will be 44,000 plus 49,370 minus 6960. This gives you 86,410. So 86,410. This becomes our net capital employed. That is non-current assets plus current assets minus current liabilities. And then we come here and say financed by. Financed by. So financed by, what do we have? We have financed by. We have the go back to the question. Just see what we have. We have, of course, capital accounts. Capital accounts, Dan and Lucy, 3220. And remember, Pendo added in 24,000. So Dan, Lucy, Pendo, 3220 and 24,000. The 24,000 for Pendo is here, item number 2. So capital accounts, Dan, Lucy, Pendo. We'll come here and say capital accounts. Capital accounts, Dan, Lucy, and Pendo. So for Pendo is 24,000. For Lucy is 20,000, and for Dan is 32,000. This gives you a total of 76,000. So 76,000, and then you come here, we say current accounts, and under current accounts you also have Dan, Lucy, and Pendo. Now remember, we've done current accounts, so simply go back to the current accounts here and pick these balances. So for Dan, 7455, Lucy 0, and then 2955. So 7455, 0, and 2955. So add 7455 plus 2955. This gives you 10,410. 10,410. When you add the two, you'll get 86,410. And this, hopefully, yeah, it's the same. So we say this is our net capital employed. Net capital employed. So that's how we go about it. 86,410, 86,410. Net capital employed, and we are done with this question. So that is the solution for that question. That is the solution for that question. By going through all those steps, you'll be able to get all the marks that have been allocated to that question. And remember, you don't need to spend a lot of time in this question. This question should take you at most 30 minutes. It's not fairly complex. It's not complex. It's fairly, no, it's a fair question. So less than 30 minutes will be good for you. For us, we have taken how many minutes? 45 minutes, but it's because I was showing you. So thank you. Share and subscribe, and success in your exams. Thank you.